Mortgage interest rates, mortgage interest rates, mortgage interest rates. Yes, mortgage interest rates have been back on the rise as of recent. And really, why is that because? Is it because there are still too many dollars out there to buy up too little products, which is the definition of inflation? Or is it something maybe a little bit more? Well, stick tuned to this video because we're going to go ahead and cover that and more and really kind of show, is it because the economy is really doing as good as it's saying in all of the numbers reporting coming up? Or is it just because, well, maybe there's outside influences that are bucking back against how the economy is truly doing? Stick around to the end of this video because we're going to cover this and so much more and what to expect now in the real estate market right here in the greater Treasure Valley area. Well, welcome back after that quick break, everybody. Mike Petras here with MPRE Residential, powered by Next Home Treasure Valley. And yes, we are going to be discussing mortgage interest rates in this video. What's been really going on with them and what can we expect to happen here in the real estate market right here in the Treasure Valley due to it? Are we going to continue our market correction? Will stabilization come still? Or will, if any, continued market correction be very short-lived? So what do we know today? Well, basically, we know that the interest rates have been back on the rise. In fact, actually even cracking into the sevens. And we do know that the Fed is trying to address several different factors leading to really the inflation problem that we have. One of them being jobs, the job market being way skewed with more available jobs available than workers to be able to fill them. So strong labor market. They're trying to attack housing. They're trying to attack wage growth. Well, let's go ahead and start off with one of the big key factors and kind of filter through what the Fed is trying to do. And let's start off with that jobs market. Again, we know that the labor market is really strong. There's more available jobs right now than people willing to fill them. But this is also what really started the opposition to the disinflation that we're seeing over the last couple of months. And in order for bonds and notes to sell at a lower interest rate payment to other investors, they have to lower the price. Why? To increase the attractiveness of the yield. The coupon rate divided by the actual bond price determines the yield. That means more money for the investor that picked up that bond or note on the secondary market. Make sense? Plus, now if inflation is becoming entrenched, this also chips away at the face value of the note. But what you need to know in essence is that the markets always generally react before the Fed actually makes any moves. And the markets see a positive economy numbers or positive economy data in an economy that we know that has high inflation, that the federal funds and the Federal Reserve is going to have to get more aggressive and hold it for longer. So the markets are really doing anything that any of us would do, and that's protecting their money. But what you need to know when it comes to housing and mortgage interest rates is that when bond or note prices fall, the yields go up. And when the yields go up, so do mortgage interest rates. Let me say that again. When bond prices go down, note prices go down, then we can expect the yields to go up. And if yields go up, so do mortgage interest rates. But the non-farm payrolls and the ISM Services Index back in early February was not the only bad information that it came out throughout the month. We're also talking about the core CPI and core PCE reports and year over year. Both of those actually also showed that inflation was bucking back against the Fed's monetary policies. And who gathers the information for the CPI and PCE reports? The Bureau of Labor Statistics and the Bureau of Economic Analysis, both government agencies. And that's not it. The Bureau of Labor Statistics also controls the data reporting for the non-farm payrolls. And what do we know back on February 2nd? Is that they made a seasonal adjustment to those that nobody can seem to figure out the mathematical equation. And most economists here in the US said that actually the jobs really didn't go that direction. And furthermore, to really solidify the point, what happened a couple of days after the non-farm payrolls and the ISM Services Index came out? That's right, the State of the Union address. Coincidence much? But let's not dive into potential conspiracy theories. Let's go ahead and just go by the numbers. So let's just go ahead and switch back gears back to inflation and how it erodes at the bond's face value and why this is making investors nervous with the economic data that's coming out. As mentioned earlier, inflation erodes at the bond's face value, or in this case, the 10-year Treasury note. This is a particular concern for longer maturity Treasury notes. But how? So say or invest $1,000 into a Treasury note, a 10-year Treasury note at a 3.5% coupon where it is today. That coupon being fixed for the entire length of the note. So I will get $35 per year based on the $1,000 that I will get back towards the end of the maturity date. Inflation is currently sitting at 6.4%. That means that I am currently losing 2.9% of real face value money, or real future value of the money. So inflation is eating at my bond's actual real value. So why invest at this moment if inflation is just going to eat away at my investment? Good question. And this is why we're seeing a lot of investors go to TIPS, which is basically Treasury inflation protected securities, or they're running into gold, or they're just holding their money in plain old cash. However, if inflation does go down below the coupon rate, well, then you see the balancing act. But in essence, right now, the real gains that you can really make due to inflation off of your 10-year Treasury note, nominally as compared to what inflation is going to do in a real value, is a deterrent to the current bond market. And people are selling their notes in the secondary markets at a price drop in order to make up the difference and offer a higher yield to an investor that comes along and picks it up in anticipation of a higher yield note being issued later on down the road. Confusing, right? What this is all boiling down is just trying to say that the notes and the bond markets are actually going down in price. And again, as we know that price goes down, we know that yields go up and mortgage interest rates go with them. So what does this mean? It means that the markets are really paying attention to the inflation data that's coming out, and they are really reacting to it because they're going in anticipation of what the Fed is going to do with their monetary policy. We're going to go ahead and dive into this a little bit later on down in the video, so please stay tuned. But the bond and note markets are really waiting for disinflation information to come out in the data again. So we'll just have to see when that's going to come around, but I think sooner than later. And why? Because there seems to be a lot more certainty in what the Fed is going to do with the federal funds rate and their monetary policies than we had, say, 6 months ago when they had no clue. But let's focus back on jobs and, well, really kind of everything but jobs. The Fed currently wants to bring the jobs market back to an even playing field. How will they do this? By increasing the federal funds rate. By increasing the federal funds rate, it will make it harder for businesses to borrow cheap money for business expansion or just good old business growth. There's also the matter of debt. Those companies with high debt will end up doing layoffs, freezing their employment, or they'll actually do pay cuts. In all, what happens? The unemployment rate increases. And this slows the circulation of money as consumer demand drops, which is what the Fed wants. This in turn will lower prices for products, price stability, which is what the Fed really wants. But right now, with jobs so plentiful, this gives the employee the power to negotiate with the employer for a higher salary. This results in wage increases, which is also what the Fed wants to tackle. Any additional salary that really they make in real income, not their nominal wage, not what they really make, just means more money out there to buy up goods and services. And hence, now you maybe see the correlation with the ISM services and manufacturing index. But let's look at the services. Right now, the services is on the way up. Why? Because people are out there spending more money in the services, so they say. But the ISM manufacturing index right now is actually kind of showing bullish when it comes to employment, manufacturing, basically goods. Meaning the US is not producing as much, even though the Fed really kind of came in and said, hey, goods are back to pre-pandemic levels. Either way, really in a nutshell, all these different reports coming out are showing that the Fed's monetary policies really aren't quelling inflation and that inflation is making a comeback. So with the data numbers showing that the economy is actually doing good, again, what do we know? The Fed is going to get in there, they're going to adjust their SEP, they're going to adjust how aggressive they're going to get, and they're going to make different monetary policy decisions in order to combat inflation. And we already know what happens in the bond and note markets when this happens. So what can we expect? Maybe mortgage interest rates to continue to be on the rise or stay about where they're at in the high sixes, low sevens. But either way, we're going to see how the Fed responds to all this at the next meeting. These are also the things that market investors want to know from the Fed. But there's a lot more breadcrumbs out there right now than there was 6 months ago. In fact, with all their talking points, the Fed has basically unanimously came out and said that they're just going to go up a quarter point for this particular upcoming meeting, when there were some that said we should put the screws on harder at a half point increase. This makes market investors very, very happy. But are they going to do another quarter point at the meeting following when they were anticipating that hopefully they would put a pause on it all? Yeah. So can we anticipate the Fed's benchmark rating, the SEP, to actually go up for the course of the year? Yes, we can. So now let's turn into real estate and see what's going to happen with it now that mortgage interest rates are back on the rise. What will this do to the Treasury Valley real estate market? Will this market correction continue? According to the data, and please watch Mikey's monthly market updates for February of 2023 coming up next week, solds went up. Pendings have also gone up, which means more solds in March when those data numbers come around. And inventories actually come down in both Ada and Canyon counties. And all of this regardless that the interest rates have been in the low sixes over the last few months. People still need housing, and this is a very desirable area to move to. We have also seen inventory levels and pending start to intermingle again. And what does this mean when we start seeing the intermingling? Stabilization to home prices, and the buyer's market, which is currently open, will close. Buyers are seeing this. Buyers are also seeing that they will marry the house but date the rate, and the rates will come down as inflation cools. But that also depends on the Fed selling off their balance sheet. But buyers are also seeing that home prices have gone down really about as far as they can go, and that their buyer's market, their buyer's window to get concessions and better negotiations is starting to close. So knowing this, they're jumping back into the game, and you can see that in mortgage applications across the U.S. that are on the rise and what's happening in Treasure Valley real estate right here. But with interest rates back in the high sixes and even into the sevens, can we anticipate the buyer's market and the available buyers to actually tick down? Yes, as the purchasing power erodes for some buyers. Can we expect the amount of pendings or solds to dip or soften? Yes. But the question is, will inventory shoot up again? And will the gap between supply and demand widen to levels to continue or even restart the market correction? And will the gap between supply and demand widen enough to continue to drop property values? Let's analyze this. Given the seasonal uptick in inventory is right around the corner, will it be so wide to create this? Well, my honest answer to this question is probably no. But why do I have a basis for that opinion? It's because before the market correction, there were a lot of buyers out there willing to buy a home because of the super low interest rates. They were actually able to qualify for a home. This means that a lot of sellers were going out there in order to sell their homes in return. And why? Because the sale of their home was almost assured, and they were able to still get a low interest rate when they made a lateral move somewhere else. But as the interest rates started to rise, the buyers in that available market started not to be able to qualify, and they basically started dipping out, which left a lot of sellers holding the inventory bag, widening the gap between supply and demand enough to be able to create price reductions and price market corrections. Supply up, demand down. The market correction. We all know that everything changed. Now sellers know that if they move and they sell their home, they will take it at a loss of the price value that they would have gotten a year ago. That is a deterrent to some, just knowing that information. But most importantly is that sellers know that if they move, they'll be subject to a higher interest rate than what they are currently locked into. So is selling really ideal now? Well, sellers, just like a year ago, just know that if you sold high, you are going to buy high. If you sell low, you're going to buy low. The difference is really the mortgage interest rates. If you sell and relocate, you'll be subject to higher mortgage interest rates. This realism should help keep the inventory levels at bay this time around. Usher in the time of selling a home for necessity. And when I say necessity, am I talking about because of job losses and homes resulting in foreclosure? That is a no. But why? First, there are more jobs available than people willing to fill them, almost at astronomical levels. So even if the Fed lands us in a recession, can we expect unemployment to reach skyrocketing levels? Highly doubt it. And as the Fed forces us into a recession, they are forced to loosen their monetary policies, which will bring businesses back online, which will mean hiring. Self-employment is also on the rise here in the U.S., which is basically circumventing corporate employment. So too the Treasure Valley. Will unemployment rise to levels so much that we will see a big jump or rise in foreclosures? The answer to that question is also no. First and most importantly is because it's nearly impossible for banks to start and complete the foreclosure process right here in the state of Idaho. Plus, foreclosures are expensive for banks. They would much rather keep you in the home, so they are going to go ahead and offer you loan modifications to keep you there. And again, even if a recession hits, other jobs should be available for your average everyday employee. And given that the Fed is most certainly going to put us in a recession now, if anything is probably going to balance the labor market, it's going to be the effects of a recession. And all this probably without a huge swing in the unemployment direction that we have seen before, which will also give the Fed a huge conundrum when it comes to loosening their monetary policies. So in essence, really the pandemic has given the Fed a situation that they have never dealt with before. But if we kind of read between the lines, we can see this kind of working its direction in basically my predictions. But again, they're predictions. We'll have to go ahead and wait and see. But drilling the point home, don't expect foreclosures to rise to astronomical levels like they did back in 2008. That was for a totally different set of circumstances, the subprime mortgage crisis, and people basically underwater in their homes before they even moved in. If you would like to know more about that, please feel free to reach out to me. So going back, and lastly, if supply and demand really widens due to mortgage interest rates being where they are currently at, when will we start seeing the effects of the market correction start again? And for how long might this market correction last for? Well, if it returns, we'll see it happen in the next couple of months as inventory starts going up for the seasonal shift and the buyer's demand starts tapering down due to mortgage interest rates. And how long will it stick around for? Well, that really depends on the mortgage interest rates. And most importantly, the economic data. Given that the effects of the last federal funds rate increase is yet to really kind of show, and now that it's most assured that they're going to do it the next couple of meetings, inflation data should swing back in the right direction towards disinflation. In fact, it's not as if the data that's coming out currently is really shooting up to create big panic in the markets. It's just kind of more or less being a thorn in the side. So I believe that this mortgage interest rate spike that we're seeing is going to be short-lived. I also believe that the market investors see this, that it's going to be short-lived as well. And they know that the data will turn around soon. And as they invest, the price of the bond is going to go up, which is going to lower the yield, which is going to lower mortgage interest rates. If we know that the current buyer pool at the low sixes that we had over the last month, if they are comfortable in that aspect, they're going to continue to return to this market. Plus, the markets now have a good pulse on what the Fed is going to do. There's not a lot of mystery in their rate increases. They are more in tune, and the Fed has more answers. So will there be a slight lull in probably property values? Most likely. And is it going to stick around for long? I don't anticipate that to be the case. So expect stabilization to happen still this year and inflation to cool as mortgage interest rates also come down. So we'll continue to anticipate that. But what data do we got coming up? A new CPI report comes out on March 14th, but don't expect this data to really kind of show favorable numbers. But if it does, that'll be great for markets. But we can also just guarantee that the Fed is going to raise another 0.25% at this next meeting and raise their SEP benchmark to increase the federal funds rate and hold it for longer. All in order to show better inflation data in the US and get back down to their 2% goal. But we'll just have to wait and see. But as always, thank you so much for sticking around for this video. And of course, if you have any further questions or you are looking to buy, sell, or invest in real estate right here in the Treasure Valley, please feel free to reach out to me. You can see my information below. I look forward to hearing from you, answering any questions, and setting up the right fit for your possible relocation from out of state or even a move right within here in the Treasure Valley. So I look forward to hearing from you. Well, thank you again very much, everybody. God bless. I look forward to the day I call you my neighbor. Until then, thank you so much. Bye-bye.